All right, welcome to this explainer. I am so pumped to get into our topic today because we're finally going to strip away that intimidating black box aura that usually surrounds financial modeling. If you've ever looked at a massive spreadsheet full of discounted cash flows and just felt totally overwhelmed, trust me, you are not alone. But today, we are going to reveal the true art and science of valuation. We're getting right down to the philosophical bedrock of what things are actually worth.
Okay, let's dive into this with a brilliantly sharp observation from Oscar Wilde. He wrote that a cynic is someone who knows the price of everything but the value of nothing. And that perfectly sets up our core conflict today, knowing a price versus knowing a true value. As you'll see, the market is constantly shouting prices at you, literally every second of every trading day. But value? Well, that requires a little more digging.
So on one side of this conflict, we've got what's often called the bigger fool theory. This is the belief that the intrinsic value of an asset is completely irrelevant, as long as there's a bigger fool out there willing to buy it from you at a higher price later. That is a dangerous, dangerous game to play. On the flip side is the fundamental postulate of sound investing. The idea that financial assets are acquired for the cash flows they're expected to generate. A sound investor never pays more for an asset than its true worth, totally regardless of the hype.
Our guiding light for this explainer is literally the authoritative text on the subject Investment Valuation by Aswath Damodaran. What is so fascinating about his work is how it proves that while the specifics of, say, valuing a commercial real estate property differ entirely from valuing a publicly traded tech stock, the underlying principles are strikingly similar. The philosophical framework we're exploring today applies to virtually any asset you'd ever want to value. But to build that foundation, we first need to clear some rubble.
Section 1. Debunking Myths, the Illusions of Finance.
Because this discipline has developed its own set of persistent, stubborn myths over time, let's strip away the illusions. Here's the first major one. Because valuation involves spreadsheets, algorithms, and complex math, we naturally assume it's a hard science. We have to ask ourselves, does all this quantitative modeling guarantee an objective, scientific result?
Yeah, the resounding answer is no. Valuation is absolutely not an objective search for true value. Yes, the models are quantitative, but the inputs we feed into those models leave plenty of room for subjective judgment. The final value we get at the bottom of the spreadsheet is heavily colored by the biases we bring into the process from the very beginning. Honestly, people often secretly set a target price first, and then just build a valuation backward to justify it.
So the crucial point is that human psychology and self-interest color every single financial analysis. Take corporate takeovers, for example. The decision to acquire a company almost always precedes the actual valuation, meaning the math is just retrofitted to justify a deal the CEO already wants to do. For equity research analysts, there is massive institutional pressure to issue buy recommendations. If you slap a sell rating on a company, you risk losing access to management, getting frozen out of earnings calls, or even jeopardizing lucrative investment banking deals for your firm. And when target firms value themselves in a takeover, of course those numbers are going to be hyper-optimistic. You always have to ask who is doing the valuation and what's their motivation.
Which brings us to our next myth. Let's say you somehow eliminated as much bias as humanly possible, and you've built a perfectly constructed, deeply researched valuation model. Is that valuation a timeless truth? Does it hold up forever? Absolutely not. Financial markets are living, breathing ecosystems where information flows constantly. A valuation ages incredibly quickly. Whether it's a new earnings report, a massive shift in an entire sector like healthcare reform, or a macroeconomic change like rising interest rates, new information forces analysts to constantly update their models. A valuation is a snapshot in time, not a permanent monument.
And you shouldn't feel bad about that. When someone criticizes an analyst for changing their valuation target, the best defense is this classic quote from the legendary economist John Maynard Keynes: "When the facts change, I change my mind. And what do you do, sir?" Changing a valuation over time isn't a flaw in your methodology, it's literally the only rational response to a changing reality.
Okay, here's one more myth, and it's a trap so many incredibly smart people fall into. Does a more complex, highly quantitative model automatically equal a better, more accurate valuation? Like, if we just add 50 more variables to our equation, do we get a smarter financial decision?
That is a hard no. Thanks to the principle of parsimony, this is the golden rule that states you should never use more inputs than you absolutely need to value an asset. When you make a model overly complex, Actually, scratch that. When you make it so complex it turns into a black box, you lose the plot. You start feeding numbers in one end without really understanding how they interact, and when the valuation fails, analysts just blame the model. But remember, models don't value companies. You do.
Section 2. 3 approaches, from philosophy to practice.
Now that we've debunked those myths, let's transition from philosophy into practice. How do analysts actually tackle the real-world challenge of putting a dollar amount on an asset? Well, it basically boils down to 3 primary approaches, and they are incredibly distinct. First up is discounted cash flow, or DCF. This relates value directly to the present value of expected future cash flows. This is the search for true intrinsic value. Next is relative valuation. This estimates value by looking at how similar, comparable assets are priced in the market, like looking at the price-to-earnings ratios of similar tech companies. Finally, contingent claim valuation uses option pricing models. This is absolutely perfect for things like patents or early-stage startups, where cash flows aren't just far out, they're highly uncertain and entirely contingent on specific risky future events playing out.
And this brilliantly illustrates how these approaches exist on a spectrum. If you're valuing a highly unique asset or business, you're going to lean heavily toward discounted cash flow or option pricing simply because there's nothing out there to compare it to. But if you have a huge number of similar assets that are actively priced by the market, like, say, residential houses in a large subdivision, relative valuation becomes incredibly powerful and practical.
Your time horizon also completely changes your approach. If your time horizon is practically zero, you're looking at immediate liquidation value. Relative valuation is great for shorter-term portfolio management because you're playing market trends. But discounted cash flow, that assumes a long time horizon. You're evaluating the asset as an ongoing concern far into the future, which is exactly why it's the gold standard for major corporate acquisitions. Let's move to the next piece of the puzzle and see how this builds, because your choice of model also reveals your underlying market philosophy. With relative valuation, you're effectively market neutral. You're assuming the market is basically right, on average, in how it prices a sector. But with DCF, you're taking a definitive view. You're out there saying, I believe the market is wrong right now, and I have found the true intrinsic value. It takes a lot of confidence to stand by a DCF model when the rest of the market disagrees with you.
Section 3. Embracing estimation noise, the reality of uncertainty. All right, this brings us to the real climax of our explainer. We've got to address the elephant in the room. The inescapable fact that no matter which approach we use, we can never perfectly predict the future. We have to talk about estimation noise. When beginners build their first financial model, they usually experience massive anxiety because the numbers are never perfectly precise. They look at a wide range of possible values and panic, asking, does this estimation error mean my model is broken? Now, what's really interesting here is how we can completely reframe that anxiety. The answer is no. Uncertainty is simply a fact of life, especially when you're valuing young, fast-growing companies. Estimation error is not a flaw in your math, it's an honest reflection of the reality of the market. Instead of sweeping that noise under the rug by using crude shortcuts, we have to boldly confront it, run our simulations, and embrace the uncertainty.
And that leaves us with the ultimate question, the one you have to ask yourself every single time you invest. Look closely at your own philosophy. Are you truly doing the hard work to value a business's expected cash flows? Or, deep down, are you just hoping you can eventually sell it to a bigger fool? Think on that the next time you look at a stock price. Thanks so much for joining me on this explainer, and I'll catch you next time.